welcome back to the afternoon session. So we've got 4 more exciting papers coming in the next few hours. And so, I won't beat around the bush, as we say in my home country. So let's jump right in. So the first paper, so this session is called about access to mortgage credit. The first paper, political voice and mortgage market participation, evidence from minority disenfranchisement. And Arkodipta Sarkar from HKUST is going to be presenting the paper.
Okay, yeah. So firstly, thank you for having the paper in the program and for accommodating me for this online talk. So this paper is using an evidence of disenfranchisement of the minority in US to understand how political voice can affect participation in the mortgage market. So the main motivation of the paper comes from the fact that we know that having a political voice or power to affect elections is kind of a gateway to advancement in various aspects of life. And who better than Martin Luther in his speech, Give Us the Ballot, who succinctly puts it that so long as I do not firmly and irrevocably possess the right to vote, I do not possess myself. I cannot make up my mind. It is made up for me. I cannot live as a democratic citizen. I can only submit to the edicit of the others. So political voice or voting rights are important. And not surprisingly, there have been a lot of studies that have looked at enfranchisement, but particularly in the provision of public goods. However, the microeconomic evidences to study the relationship between enfranchisement or having a political voice and individual decision-making is limited. So, for example, like the questions like, do agents respond to changes in voting rights through their economic and financial decision? That is, whether agents incorporate having a voting right when they're making their economic and financial decisions. Can exclusion from the voting process can result in exclusion from markets in general? And to what extent differential voting right can lead to inequality? Now, and also what are the possible mechanisms for it? Now, we think that understanding the effects of such changes in voting right can have an immediate policy relevance. And so what we do in this paper is to try and provide empirical evidence on the link between electoral disenfranchisement and economic decision-making. So what we use is we use a particular episode of 2013 when the Voting Right Act, which had been universally provided in 1965, was diluted. We use that as an exogenous variation in voting rights, and I'll talk about it in much more detail when I go ahead. And using this, we find that following this dilution of the voting rights, we show reduction in mortgage origination of Black Americans. So the results that we find points to a decrease in mortgage market participation of the applicants. We do see a reduction in loan application to start with. We do not see any significant change in denial rate. So what we think is going on is that individuals whose voice was diluted self-select themselves out of the mortgage market. And what we think the result is primarily driven by increased fear of rejection. So they fear that potentially they'll be rejected when they apply for loans, and rejection is costly. So they're self-selecting themselves outside the market. And such fear of rejection as a main difference in mortgage application had been highlighted by Charles and Hurst, who conjectured that fear of rejection is potentially one of the reasons why there exists a difference in mortgage application across 2 different groups. Now, why do we particularly use this setting to answer the question? So the main question that we are after to answer in this paper is we attempt to answer the relationship between enfranchisement and economic decision-making and consequent inequality. Now, home purchases, we think, is a natural setup to answer this question, or it provides a laboratory for the empirical investigation, because home purchase is one of the most important economic choice that a household takes over their lifetime. And it's also an important medium of wealth accumulation and also potentially transfer over generation that can affect the well-being of individuals. Now we focus on mortgage market outcome as a setup because home mortgages are an integral part of home purchases. Like more than 70% of all homes that are owned by Americans have some form of mortgages linked with it. And also the data on mortgages have the richness that we can exploit for some form of causal comments about the paper, where we have the information on race and location of borrowers. We can track a mortgage from application to origination and rejection. And it allows us to make some comments on whether the effect is coming from the participation aspect of it, or it is coming from individuals getting rejected after they have applied for a loan. So broadly, we want to understand the home purchases of individuals which is affected by the lack of political voice, and we use the mortgage market as a setup to answer this question. Now, this is just to understand how enfranchisement can potentially affect mortgage application. So firstly, disenfranchisement there are papers which have shown that disenfranchisement or having a political voice affects income. So removal of political voice can have a negative effect on income and can act as a barrier to apply because your financial constraint might be tighter, or there could be an increased fear of rejection. You could fear that you might potentially be discriminated when you go ahead and apply. So you tend to self-select out of the market. And finally, there could be a migration from one place to the other, which can mechanically result in reduced application of the group who ends up migrating. And so we'll try to see which of these effects kind of we think are dominating in our study. So first, let me give you a brief overview of the institutional details. So firstly, in 1965, as we know, the growing racial disparity led to the emergence of the civil rights movement, and consequently, VRA was enacted, which is the Voting Rights Act. The Voting Rights Act had several sections, but let me highlight two sections. One, Section 2, which had provided, eliminated all voting restrictions. And there was another section, Section 5, that empowered federal authorities to have oversight powers to protect minorities' right to vote. So if any state wanted to impose any restriction or hard measures in the process of voting, they would require a pre-clearance from the federal authorities. That is what this Section 5 of the law provided. Say any kind of stricter identification law or reduction in polling station or purging or any such activity needed a federal oversight. According to this Section 5. Now, 2013, what happened was that in a 5-4 US Supreme Court ruling, it made Section 5 to be unconstitutional. So this was in relation to one particular case of Shelby County versus Holder case, and the Supreme Court made this Section 5 unconstitutional in a 5-4 kind of ruling. And one of the dissenting judge, Justice Ginsburg, said that throwing out pre-clearance when it has worked and is continuing to work to stop discriminatory change is like throwing away the very umbrella in a rainstorm just because you are not getting wet. So she compared it with just like something throwing away the very thing that protected for long. Now, the ramification of the repeal of this Voting Rights Act was rather very immediate. So within 24 hours, Texas announced strict photo identification laws. There were several other states that followed suit. So in one particular case, which went up to one particular case where such restriction was imposed, and it went and it was a challenge in the court. So the judge said that the new provisions targeted African Americans with almost surgical precision. So this new rights, though it was not like in terms of definition, it didn't move against one community, but the way that it was implemented, it targeted African Americans with almost surgical precision. Now, and this was also not salient during the time that it was passed. So in the first panel, you can see the Google trend for VRA. So the not covered counties were the counties which were not covered under the Section 5. So when this Section 5 was repealed, these were the counties which were not affected. So you can think of this as the control counties, and covered are the treated counties. And we see that the intensity of searching for keywords related to Voting Rights Act was much higher in the covered counties. In the second panel, we see voter purging, which is removal of voters from the voting roll. So in the first panel, we see the not covered counties, like the control counties, and the blue bar is federal election of 2008 to 12, and the red bar is the elections of 2012 to 16. So we see that there's a sharp jump in the purging in the election that happened after the repeal of VRA, in particularly the covered counties, which are the treated counties. And finally, we do see a sharp reduction in turnover of Black voters in the elections after 2012, particularly in those counties that were the treated, or the counties that were covered under this law. So these are just to show that this was actually salient at that point in time. Now let me give you a brief about the empirical strategy that we would like to we exploit in this paper. So firstly, we look at the sample of so these are the sample of so the blue places are the counties which are not covered under the Section 5, and the red places were the counties that were covered under Section 5. So the removal of Section 5 led to the dilution in the red counties, but not in the blue places. So for the empirical strategy, we look just at the bordering counties. And to give you the baseline specification, so we do the regression approach takes kind of a geographic RD design, where we look at a census tract and see how far is it away from the border. And we particularly look at the border county pairs, and we look at how the treated county is different from the control county. And within the treated county, how the Black Americans, whose right was particularly diluted, is affected relatively more than the white Americans in the treated county itself. So we particularly have a triple difference, and we also exploit the geographic distance through this functional form of the distance of a census tract to the border. And we also look at a dynamic evolution across the time of this repeal of the law. Now, let me show you some baseline results. So firstly, we just plot like a univariate results of the difference of mortgage origination of white Americans in the treated vis-a-vis the control counties, which is the blue dotted line, and the red line is the difference of Black Americans in the treated minus control counties. So we see a sharper drop in the mortgage origination and application of the Black Americans. And this is just showing the full set of regression tables using like very tighter fixed effects, where we can just look at the difference that are happening between two Black Americans, one who is located in the treated county vis-a-vis another who is located in the control county. And you compare that with another set of people like white Americans who are located in the treated versus control. And you also look at the pre and post, before and after this law was repealed. And we do see a reduction of roughly around 14% of the amount of loan and 8% in the numbers in origination, and kind of similar in applications. However, we do not see any kind of change in the denial rate. So for the and then the next set, we just show how the evolution across time, and we do see that there is little pre-trend, and it sharply declines just after the repeal of the law, precisely just after this particular law was repealed or diluted. So we do several robustness checks. I'll not go over this robustness checks in detail. Now, let me talk briefly about the mechanism. So as we had highlighted, there could be three channels. One, individuals could just migrate outside. there could be fear of rejection, or there could be some form of other borrowing constraint. Now, to highlight the migration channel, can I ask how am I doing with the time?
10 minutes left.
Okay, good. So to highlight the migration channel, we look at how migration happened in like pre and post in the treated and controlled counties, particularly in those counties which have a higher share of Black population. And we do not see any kind of effect happening in migration. So at least instantly, there's no migration that is happening. So the results that we're observing is not a mechanical outcome of the fact that more people are migrating outside of the treated counties. The next, then we are left with either it is coming from a fear of rejection channel or a borrowing constraint channel. So to try and shed some light on that, we look at lending across two different types of lenders, like lenders who have a history of lending to Black borrowers. These are small community kind of banks, and the other set of non-traditional, non-Black lenders, which are the typical traditional banks. So if it would just be borrowing constraint, we would have observed a reduction across the board. But we over here see that there is migration of Black borrowers or borrowers from the traditional non-Black lenders to the Black lenders. So what we find in the first two columns, that it's kind of in line with what we're observing in the earlier tests as well, that there's a reduction in the amount and the number of application. However, when we look at Black lender, we do see a reallocation, that is the amount of application to a bank which has a history of lending more towards Black community goes up, and the number also goes up. And we do an interaction between the different kinds of lenders where we can look at the same borrower across two different lenders as well, and we find kind of a similar result, that there is a reallocation happening of particular borrowers from the Black community who is moving from a traditional bank to a small community bank. So this, we think, is kind of driven by a fear of rejection, where individuals think that the traditional bank are likely to reject them, while there could be some form of cultural proximity or homophily that is driving them to move towards a more familiar lender. Now, another test for the fear of rejection is that we do find it across different buckets of income. We do not see that that the effect is only for people who have a stronger constraint in terms of their income. We do see that the effect is across the broader income distribution, so which also provides some evidence against the borrowing constraint kind of story. We also see there is a reallocation of home purchases from usage of mortgages to usage of cash. Now, of course, like everybody is not endowed enough to use cash, so this is for a smaller sample who has potentially the ability to use cash. So they are kind of reallocating from mortgage use to the use of cash. This also goes ahead and kind of highlights that the results are potentially driven by some form of fear of rejection. Now, just to highlight that this fear of rejection is coming from the overall fear that is existing in the environment. So we do see some surveys that talks about attitude towards a particular community, and we do see that the attitude towards the Black community goes down in the treated counties after the removal of the laws, which is kind of highlighted over here. And we also see that there are more hate crimes that starts in the treated counties after this law was diluted. So after the political voice was eroded, there are more hate crimes that are coming up. And we think that this can have a manifestation on, like, the general fear could be manifested in the fear to borrow from the banks as well. Now, just to show some real effect of what we observe, so we find that this effect kind of persists in home purchases as well. So we look at actual home ownership, and we do kind of the same result, same test, but instead of mortgages, we look at just home ownership, and we do see that home ownership of by Black Americans in the treated counties goes down significantly after the dilution of the Voting Rights Act, which is just kind of showing that the mortgage result that we're observing is also manifested in the home ownership result as well. And just to show some form of external validity that there is this result is kind of holds in a general context as well. So there is kind of an index that is out there, which is called cost of voting index, which is measured at the state level, which shows how costly is it for an individual to go ahead and vote. We do see in the first panel that there is a positive relationship between this cost of voting index and the racial home ownership gap. It says that in a place which has a higher cost of voting, the racial home ownership gap is also higher, which is kind of similar in line with what the story that we are saying so far. Then we are trying to see how much can the cost of voting explain the home ownership gap, and we kind of plot this model R square across different states, and we do see that the explanatory power of this voting index in home ownership gap is particularly higher in those counties which or in those states which had kind of this protection from the Section 5. And finally, we do see that there is an inverse relationship between this model R square and racial harmony. That is where this R square is high, that is where places where this voting index or the cost of voting index can explain the gap in home ownership, the racial harmony is also lower. So this kind of broadly ties our result in kind of a more general context, that there is this relationship in general of this cost of voting and the home ownership gap. And finally, just to conclude, so we identify the effect of electoral disenfranchisement of Black Americans on their mortgage and borrowing decisions. We see that the effect is likely driven by an increase in the fear of rejection. We think that the effect could come through migration of Black Americans, the effect being constant across income group, and substitution from the mortgage to usage of cash. And all these three taken together kind of suggest that the effect is coming from fear of rejection. So, and we do see that the real effect is manifested in home ownership gap. And we think that the result in general expands our understanding on the social and economic context of the change in voting power. And finally, we think that like when the right was repealed or when the voting right was diluted, it was said that 50 years was enough for this voting right to be there. But what we think is 50 years, even after the passage of the voting rights, the ballot does still need some form of protection. And with that, I'll end my talk. So thank you.
Great. Thank you so much. So the discussant is Stephen Ross from the University of Connecticut.
Thank you. And I'll make sure to remember to speak into the mic because we have an audience online. So this paper is really important. If we think about the key results, they're going to show that the Voting Act's right restrictions potentially lead to declines in the voting by Blacks in pre-clearance states. Then they show racial differences in mortgage applications, originations, home purchases in the same pre-clearance states after the Supreme Court decision, no effect on refinance mortgages, and results are robust to, for example, using this regression discontinuity, distance to the boundary approach, as opposed to just comparing counties overall on either side of the boundary. And if you look, the racial differences, they didn't show you this figure, but if you look at the declines for whites in terms of homeownership volume and the declines for Blacks in terms of homeownership volume, most of the decline is being driven by declines by Blacks, although there are some declines for whites as well. It's not simply a white increase that's showing up as a racial difference. I think what's really important about this paper is this idea that voting plays a role as being part of a social contract, right? And that's something they try to tell the story. We have this social compact. When there are violations of this social contract, people start to disengage who've been basically excluded. And so that means individuals are going to reduce their commitment to the economy, their commitment to the society. They may make less investments. This could mean less pursuing of education, less purchasing of homes. In this case, this is an example, perhaps, of how these types of effects are affecting investments in homes and neighborhoods, but it could have broader effects as well. And that makes the question they're asking very important. However, it equally makes it very difficult. And I'm going to try to highlight some of the places where I'm not quite convinced and where I would like to see some more work and try to make some suggestions along the way. I think one of the most important things to convince people of is convince people of the salience of Shelby versus Holder, right? Were minorities aware that they were in a pre-clearance state versus not in a pre-clearance state, right? The paper does show nice evidence on voting, nice evidence on hate crimes. And so the question then becomes, is this disenfranchisement caused by these Supreme Court decisions? What's driving it? All right, is it the Supreme Court decision? Is it something else that came from the Supreme Court decision? They suggest, for example, that it's fear of being rejected. Well, it's unlikely that I'm going to say, oh, I can't vote now. I'm afraid I'm going to get rejected for my mortgage. So perhaps it is not from the Supreme Court decision, but it might be from state actions that follow that decision, right? So it might be, for example, they're not responding to the Supreme Court decision, they're responding to the negative press arising from these voter ID laws, right? Or they might be responding to an empowered, somewhat racist minority within the state they're in, and these more decentralized social responses are causing something that people are responding to, consistent with sort of the hate crime evidence, but we don't really know. Now, what types of state actions might drive these effects? The most direct, obviously, are these restrictions on votings might make African Americans less attached to U.S. society generally. But it's also true that historically, political power has led to economic advantage improvements for African American populations. And so when a population loses political power, it can actually have negative economic effects. And that may be why minorities are not entering the housing market as quickly. I think the Google Trends analysis is really important. They do look at this, they show this difference. I'm not sure why they do levels. Lots of times they're doing differences and then suddenly they give us this descriptive information and they do it all in levels instead of looking, for example, at changes over time. Another important question is how important are searches for Voting Rights Act, right? So, okay, yes, we see a difference in the number of searches, but one of the problems with Google Trends is you don't actually know the number of searches. You just get this index. But what Google Trends has is this compare function. When you go log into Google Trends, it usually compares Kardashian to, I think it's, the really popular, used to be country musician, and it just shows right up there, and it does a compare. So I didn't want to show you the Kardashian, but I did want to do a compare here, where we have Voting Rights Act, Black Lives Matter, and Donald Trump, just for fun. And what you're going to see is, yes, there is this tiny little spike in May, right around May 2013, about the same time as Shelby is Holder. But basically, you know, searches for the Voting Rights Act is basically just in the dirt. And then there's a few weeks right around the Supreme Court decision that gets a little bit of attention, and then it just goes away again. But if you look at more persistent effects that are showing up in 2014, a little bit in 2014, but even more in 2015, obviously, is capturing something that's going on in society. Obviously, the Donald Trump's campaign, my data here, I chopped it off a year before the election. So it's not like we're in the middle of the election, but we were starting to hear a lot of action. And he was getting a lot of searches long before anyone counted him as a serious candidate. Black Lives Matter, while it's small compared to Donald Trump, really jumps up dramatically throughout 2015. So there's a lot happening during this time period. I also got this figure on hate crime trends, and it really is sort of striking. There's something very special about 2014. There's this relatively long decline in hate crime trends over time, and then it really does turn and flip. But I just am not convinced that this turn and flip that we're seeing in hate crimes is necessarily due to Shelby Holder. Lots of things were going on. Do I really believe that Shelby Holder was the cause behind this reversal that led to the rise of Trump, that led to the rise of more insecurity of African Americans contributing to Black Lives Matters, that led to, as early as 2014, this relatively dramatic reversal in the trends of FBI reports of hate crimes? And that's where I sort of, a lot is happening. 2014 is a big year, and things change in 2014. But was it really the Voting Rights Act? Thank you. Another Google search, 2014-2015, race relations in U.S. at a low point in recent history. Whites more optimistic than blacks on race relations. Blacks and whites see race issues differently. I don't see the volume of activity about the Voting Rights Act that I see about race relations across the country. And that, I think, is a challenge they're going to have to really grapple with. Another big challenge I think they have to grapple with is the fact that these states are so concentrated. When they showed you the map at the end, and they showed you the R squared, and the R squared was so much different in all the pre-clearance states, that's a cross-sectional difference. That's not changes, right? So when you find this really high R squared in all of these southern states, it's telling us these southern states are really different than these other states. Now, it doesn't look as bad when you think about the fact Arizona, for example, that's not Texas, that's not Alabama, that seems like a pretty good treatment state. And Oklahoma, for example, seems like a pretty good treatment control state, because Oklahoma is pretty all white, relatively not friendly to African Americans on average, not trying to stereotype any state. It does seem like when we compare the states that are in the control group and the treatment group, we do sort of span some cultural boundaries here. But then when you use a boundary approach, you lose that span, right? Because when you look at Arizona, Arizona, if you were comparing Arizona to Arkansas, you might feel pretty good about it, but you're not. You're comparing Arizona to California, to Colorado, to New Mexico. When you look, for example, where we have Oklahoma as a control group, one of our more conservative control groups, but we're not comparing Oklahoma to, for example, Georgia or Virginia, we're comparing Oklahoma to Texas, right? And so when you go to this boundary approach, which I love the boundary approach usually, to some extent, what we do is we lose a lot of the coverage. Right? If you think about having span over domain when you have treatment and control, you want your treatment and control to have a lot of span. We look at the states, we have a fair amount of span, but when we go to the boundary approach, we eliminate much of that span. And that's a concern. So one thought I had is they could separate these boundary counties between cases where the boundary county the treatment county has a high share of Democratic voters versus the treatment county has a low share of Democratic voters compared to the county. Because that would allow us to say, well, if we look at the treatment states where the treatment states are along the boundary are more conservative, are we getting the same estimates when we look at the treatment states where the boundary states are more liberal, boundary counties are more liberal compared to the control counties? And if we find that we can send the same effect, I'm more comfortable that it's part of the Voting Rights Act. But if we find a different effect, then I'm worried it's differences between states. Other issues, I think I'm almost out of time. Do I have 1 minute left or not? Other issues, the regression discontinuity analysis is the most convincing evidence, but we do also have evidence that discontinuities matter. Right, and so state boundary discontinuities that's a big boundary. Bear, Ferreira, and McMillan show pretty modest difference, notable differences looking at attendance those boundaries. In my own work, we find pretty large differences looking at school district boundaries. State boundaries could separate sort of large differences between places. A lot was happening in the recovery of the mortgage market. I'm really uncomfortable about this shift towards cash purchases. My instinct is that cash purchases are primarily affluent whites making cash purchases, heavily non-owner occupants. Why did that change in 2014? How could that have anything to do with the Voting Rights Act? And if it doesn't have anything to do with the Voting Rights Act, then I need to worry about what else was happening in 2014 as part of the recovery of the mortgage market. They also find declines for whites, they're smaller than blacks. And there, I think what I'd like to see is something to show me it really is race. So for example, maybe they could run the same analysis by income bins and show me that while blacks have big declines and whites have small declines, they don't also see that higher income people have small declines and lower income people have big declines. That might be really helpful. But it's a really important topic. It's just a hard problem also. And so the more work they can do on these issues.
Steve, thank you very much. Right on time. Arkodipta, why don't you briefly respond, and then we'll go to some questions.
Firstly, like thank you so much for the comments. Like this is very helpful, and we do kind of like try to show that these things were salient. Firstly, to look at Google Trends is one thing that you were saying, and probably we should make some change. But we do also see like some, say, purging of voters, which is more direct evidence or turnouts. But having said that, we should try and do more on the kind of salience thing. But in general, like the point that there are so many other things are also going, like say Black Lives Matter and the other features. So what we are just trying to argue that potentially this Black Lives Matter, the impact of those kind of movements were kind of similar in these two counties which are bordering each other. So that is the underlying argument that we are trying to make. And given that like several other like macroeconomic effects that were going on, we do try to show that these were something that were not differently affecting these two places before the law was repealed. But yeah, so that is just to say briefly, but like thank you so much, Steve, for all the comments. I'm really looking forward to incorporate that in our paper. Yeah. And just one last point. So this income bin effect that Steve mentioned, we have actually done that, and I just we find that the effect is kind of similar across these different income bins. Yeah.
Thanks. So I'll take one. So I think Bob has a question. Can you use your microphone?
Thank you. I didn't have a great sense of the controls that you're using, but 2013 is also interesting because we're coming out of the mortgage crisis. We have new regulations that are being implemented. We know that the amplitude and timing of what was going on in the mortgage market varied by these states. I mean, you're picking off a particular set of states. And so what do you do to rule out the possibility that part of what you're seeing in your data is merely the differences in the adjustments in the mortgage market in some of these states that are affecting certain populations more than others?
Right. So firstly, we just try to say that like the control and treatment groups, like, so we exploit three differences. One is the difference in black and white borrowers. The second is the difference in the treated and controlled counties. And the third is the difference in pre and post. We think that all these three difference kind of like exploiting this three difference is the macroeconomic parameters should affect the control and treatment group roughly similarly. And also more so the particular communities in the control and treatment groups similarly. Other than that, we do use this kind of, say, interest rate or other macro parameters and show that there is a balance across the control and treatment group. So there is no effect on that before the law was repealed. And also in the regression itself, we take an interaction of, say, the Fed fund rate or the mortgage rate times the treatment times the community as controls in our regressions as well. So like this three taken together, it seems unlikely that these are driving the results.
Great, thanks. There's a question in the chat that I'll just kind of paraphrase it a little bit. It's a question about migration. And the question is basically, you don't find an immediate effect on migration, but is it possible that the decrease in home purchases that you observe could be indicating that people want to kind of retain the option to migrate in the future? I guess I think the idea is that, it takes a while to kind of make the decision to migrate. And
I got that. Actually, this is something that we are kind of exploiting now, that this is one possible, and to be completely honest, this is one possible story that we have in mind. We want to dig more deeper into it. The idea is that they're not migrating now because migration is difficult, it's sticky, and so they probably will migrate later. So they're not purchasing homes now and probably shifting towards rental market. So we are trying to get a little bit of the rental market data to try and see whether this allocation was happening from the mortgage market to the rental market. But yeah, this is a very valid point, and we are looking into this part.
I guess I'll ask a question. I'll use my prerogative. It might be helpful to kind of look a little bit more at the characteristics of the, black lenders. I guess the lenders with a high share of historical lending to minorities, just because this was a period when there were some pretty big structural changes in the relative market shares of different types of lenders. So this was kind of the time when, a couple of years before, the sort of big banks had a very large market share in the mortgage market, and then that was kind of declining rapidly, and there was a lot of substitution from bank to non-bank lending. So I guess the first question is just it's probably interesting just for you to document, and you probably have in the paper the characteristics of these different types of lenders, but then also you make sure that what you're picking up is not something about those sort of broader structural shifts in the mortgage market.
Right. No. Certainly, we can try and look more into it. But do we think that this is likely to happen more in this particular, the bordering counties which were just covered compared to the other counties? Is something that but definitely we'll dig more into it. Yeah. Thank you for the question.
Great. And I think Adam Gurin has a question in the chat. So Josh, if you can unmute him.
Yeah, thanks. So I agree with Steve that I'm a little bit skeptical that it was a pre-clearance and voting that actually did it. And I think another thing could be that people conflate the Voting Rights Act and the Fair Housing Act, both LBJ 60s type things. And they see Supreme Court attacking voting, striking down portions of the Voting Rights Act, and they think, well, they're generally striking down the kind of Johnson era protections for minorities, and fair housing is next. And that's kind of a more direct mechanism to me than we restrict voting and voting to mortgages, because it's really direct about discrimination in housing markets and whether your mortgage is going to be approved. So I think it would be interesting to explore that. I don't know exactly how, but to me,
that's very, very helpful. It would be great if I could chat with you. I'm not there. It would be great if I would be there and could chat with you more on that. But probably I can drop you an email and kind of catch up more about this particular comment of yours.
Great, thanks. So I think we're right on time. So why don't we shift to the next paper? But thanks very much, Arkodipta, for the presentation.
Thank you, and
thanks to Steve.
Thank you for all the comments. Yeah.
All right, so our next paper is Collateral Value Uncertainty and Mortgage Credit Provision, and we're very happy to have Erica Zhang here to present the paper.
Thanks for putting this paper on the program. This paper is joined with Anthony Zhang from Chicago booth. And in this paper, we study how collateral value uncertainty affects mortgage credit provision. Most durable consumptions are financed by secured loans. And in financing those assets, the collateral value matters a lot for how much households can borrow against those assets. In a world with no frictions, the collateral value should be equal to the market price of the asset, But in reality, real asset markets have many frictions that may lead to price dispersion and also make the market value really hard to predict. And so we often see this issue in the housing market and also the used car market. Such value uncertainty may reduce lenders' willingness to lend against an asset. And this is because in a state of foreclosure, if the asset is sold at a pretty high price, the lender cannot enjoy the upside. But if the asset is sold at a pretty low price, the lender will bear the losses. And so in this paper, we study whether value uncertainty would make an asset harder to finance. And we focus on the housing market because houses are the largest asset on households' balance sheet, and also because they're pretty expensive. Therefore, the affordability of houses is largely dependent on credit access. And we then look at the real effect on home ownership and who is mostly affected. We want to study to what extent the effect we document in this paper contributes to the home ownership gap in the US. And so here to preview our results, we find houses with higher value uncertainty are also harder to finance. We measure value uncertainty using idiosyncratic price dispersion of a hedonic model. Okay, so we find mortgages that are collateralized by houses with higher price dispersion are more likely to be rejected. And conditional on approval, those mortgages tend to have lower loan-to-price ratio. And also they are receiving a very expensive cost manual. And those results are stronger if the house is bought by a borrower with a higher default risk. And so this is consistent with the collateral channel I just described. Moreover, we find the effects are not only existing in the private market, but also in the government-backed mortgage market segment. And we know that in the US market, this mortgage market is really subsidized. And there are many reasons for the GSE market segment and for the FHA market segment to not pricing any risk. And we find house price dispersion affects mortgage through the appraisal process in this market segment. And I'm going to talk about the appraisal process in a little bit detail later. And after establishing that a price dispersion affects mortgage, we then build a life cycle model to study the effect of collateral constraint caused by house price dispersion on home ownership. And so we model home purchase decisions and also consumption decisions throughout the lifetime of a household. And the household can borrow to finance the home purchase decisions subject to a borrowing constraint that is tied to the home quality choice she made. And then we calibrate the model. What we find in the calibration exercise is we can increase the aggregate home ownership rate by 1.5 percentage point if we lower house price dispersion. And this effect is almost doubled among low-income households. All right, and then consistent with some empirical relationship we observe in the data between dispersion and home ownership gap across counties, this magnitude is confirmed in the data. So in this project, we combine three key data sets. First, we get all house transaction records in the US from 2000 to 2020. And in this data, we observe sale amount, mortgage amount, transaction date, and the detailed location of the property, and also a saturated set of property characteristics. And then we get loan level information from CoreLogic. And in this data set, we observe the appraisal value of the transaction. And also we observe very detailed information about the borrower and also the loan. We also get loan performance dynamic information from CoreLogic. And then from HMDA data, we get mortgage rejection and also rejection reasons. And so in this data, we are able to observe rejection due to collateral reasons, and then we can provide more direct evidence. Okay, so we really want to measure how predictable house prices are, and so to do that, we use a two-stage approach. In the first stage, we estimated a hedonic model where we project house prices on a set of house characteristics and also a very detailed location information. And then we get the residual of this hedonic model. In the second stage, we project the residual from the first stage on the same set of housing characteristics. And then we use the estimated residual in the second stage as our predicted measure. All right, so without going into too much detail about our estimation, I want to show you what our measure really captures. So here I'm showing you the association between our estimated price dispersion measure and some housing characteristics. And so you can see that older houses tend to have a higher price dispersion. Then conditional on year built, what we see is if the house is recently renovated, the house price dispersion drops. And then here I'm showing you the relationship between price dispersion and some house quality measures. So on the left, you can see that two very big and very small houses tend to have higher price dispersion. And then houses with too many bedrooms and too few bedrooms tend to have a higher price dispersion. And in the paper, we also show that there is also a U-shaped relationship between house price and house price dispersion. And so if we can treat house price level as some true reflection of the house quality, what we can conclude from this exercise is high-end and low-end houses tend to have a higher price dispersion. And also price dispersion tends to be relatively persistent over time. So here what we are doing is to aggregate individual price dispersion to zip code level and then plot zip code level price dispersion in later years against the earlier year. So the left figure is 2010 against 2000, and then the right figure is 2020 against 2010. So you can see zip code price dispersion in later years are pretty much lined up with price dispersion in the earlier years. So far, all of the results are pretty consistent with either asymmetric information or search frictions in the housing market that have been established in the housing literature. And we want to show that the measure is not really about observable housing characteristics or model misspecification. So in the data, we also observe the most recent year of renovation, which we also include in the hedonic model so that we can capture some dynamic feature of house quality. And in the housing literature, there are many micro foundations of housing market frictions that may lead to price dispersion. And to us, we're really agnostic about those micro foundations because what's really important to us is regardless of the micro foundations from lenders' perspective, all of those micro foundations will lead to one important thing is whenever the house prices are less predictable, that will affect the fair value of the debt. Okay, so with this measure, let me show you some facts. So before I go into the empirical results, I want to talk about theoretically how value uncertainty of the underlying property can affect mortgage credit. So the most intuitive argument is this concave payoff function of debt whenever there is a foreclosure. We know that, as I mentioned earlier, in a state of foreclosure, if the asset is sold at a higher price than the original debt amount, the lender is not going to get any more than what they are supposed to get. But if the house is sold at a lower price than the outstanding loan amount, the lender will have to bear the losses. And therefore, this creates some downward pressure on the collateral value, and a house with a higher value uncertainty is a worse collateral. And from lenders' perspective, they really should price in the collateral risk. And so we call this the collateral channel because if we observe the actual effect of price dispersion on mortgage, that means lenders actually pricing collateral risk. All right, so with this argument, we have the following two predictions that we're going to bring to the data. First, for houses with a higher value uncertainty, we should see is financed by a mortgage with a lower LTV. And also conditional on LTV, we should observe that the interest rate is higher on those mortgages. And second is the mortgage that are collateralized by houses with higher prices of dispersion should also be more likely to be rejected. And second, we should be able to observe that the effect is stronger when default rates are higher. And this is especially true for portfolio loans. And so next, I'm going to show you some results consistent with those predictions. And so first, we are showing you some motivating evidence at aggregate level. So here on the left, we are plotting the loan. Here on the left, we're plotting county level loan to price ratio against local price dispersion, and the right figure is plotting the extensive margin, where the y-axis is the rejection rate at county level, and the x-axis is price dispersion. So you can see that there is a pretty clear negative relationship between county level LTV and the local price dispersion, and there is a pretty clear positive relationship between the rejection rate in a local area and the local area price dispersion. Right, so of course, this is just motivating evidence, and then I'm going to show you the regressions, the evidence in a regression setting. So in our baseline analysis, what we really want to do is to exploit this within county year variation by comparing two properties in the same county that were transacted in the same year. And we further control for lender by year and transaction day fixed effects to control for credit supply. And then we do borrower and loan characteristics to make sure this is not about creditworthiness of the borrower. And then we further include mortgage interest rate to ensure this is not about the LTV and interest rate substitution. So ultimately, we're comparing two properties with the same house price that were transacted in the same county year, that were bought by borrowers with very similar income and credit profile. And the only difference between the two properties would be either the year built, the year of renovation, or some special housing features that make one less standardized than the other. Okay, so first, this is the baseline regression. The outcome variable is LTP, the loan to price ratio. And you can see that in the baseline analysis, the loan to price ratio is about 50 basis points lower for any property that has a 1 standard deviation higher price dispersion. And cross different specification, you can see even in the most saturated specification, we still have this pretty clear negative relationship between price dispersion and the LTP of the mortgage. And then the lower LTP of those of the mortgage on those houses could be driven by credit demand rather than credit supply, meaning that those houses could have a lower price and low-income households tend to have a lower demand, and therefore they tend to get a lower loan in order to get a better interest rate. And so what we're doing here is we want to estimate the cost menu using all mortgages that are available in a local area. And so we estimate the cost menu for each zip code, and then we divide all zip codes into low price dispersion zip code, which is the red line, and the high price dispersion zip code. You can see that the entire mortgage cost menu in terms of the LTV and interest rate pair shifts up for zip codes with higher price dispersion. So what I mean is that for any mortgage borrower or for any home buyer that tries to get a mortgage with the same LTV level, if they're trying to buy a house with a higher price dispersion, this home buyer needs to pay a higher mortgage premium. And remember here, the interest rate is already residualized. And so this is really about the interest premium they're paying on the mortgage. And then put it in the regression setting. On the right, the panel A is interest rate. The outcome variable in panel A is interest rate, and panel B is loan to price ratio. So first, we confirm there is a relationship between interest rate and LTP. For any mortgage that has a higher LTP, it is more expensive, and vice versa. And then we show that conditional interest rate paid on this mortgage, if the collateral actually has a higher price dispersion, the LTP is lower. Right, same thing for interest rate. And then we can look at this effect at the extensive margin. Right, so here on what I'm highlighting here is the rejection rate. So we're regressing rejection rate on price dispersion. You can see in a census tract that has a higher price dispersion, the rejection rate is about 1.5% to 2 percentage points higher. And so in the sample period we're exploring, the baseline rejection rate is about 15%. And so this is really about almost a 10% increase relative to the baseline case. And then we can further look at rejections due to collateral reasons. So in HAMDA, we actually see different rejection reasons. You can see this is a more clear evidence that all of those mortgages are rejected because of collateral reasons. In the baseline rejection rate due to collateral reasons is about 2%. And if we do this comparison, this is almost a 20% to 40% increase relative to the baseline. And so this is the extensive margin, and then we can further look at if the effects are indeed stronger for houses that were bought by borrowers with a higher default. So what we're doing here is we estimated the same baseline regression for each FICO score bucket. Relative to borrowers that have excellent credit score, you can see the effect of price dispersion on mortgage LTV declines or increases as the borrower becomes more and more less and less creditworthy, right? So the effect for poor credit score borrowers is the highest. And so this confirmed that the effects are indeed more salient for less creditworthy borrowers, and this is consistent with the collateral channel. And so this is important because from lenders' perspective, the only time they really care about collateral is when the mortgage defaults. So far, all of the results are consistent with the collateral channel, and it is pretty intuitive to think that lenders should price in collateral risk if they are going to hold the mortgages on their balance sheet. But as I said earlier, the US mortgage market is highly subsidized. There are a lot of loans that are essentially sold to the GSE sector, to the government sector, or they're essentially insured by FHA. So why should lenders price in such risk if they're not going to bear the losses? And so we found that this works through the appraisal process. So in the residential mortgage market, securitizers are going to require appraisal reports in order to determine the collateral value. And when they want to determine the LTV of the mortgage, they take the minimum value between the appraisal value and the price. So how it works is as follows. The appraisal process in the residential real estate market typically takes 3 or 4 comparable houses, and they look at the prices of those comparable houses, and then they determine the appraisal value. And in fact, in reality, if a house has a higher price dispersion, they will also have fewer number of comps. If they don't have if they don't have a good comparable, the appraisal value tends to be noisier as well. And this will create some downward pressure on how much loan the home buyer can really get from their lender. And so through this process, actually GSE loans and also FHA loans are also able to price in the collateral risk, although not to the full degree. I'm going to show you some evidence. So here I'm showing you some evidence for the appraisal channel. So the x-axis here is the local price dispersion, and y-axis here is the appraisal deviation from transaction price. So as I mentioned, I'm able to observe the appraisal value, so we can really calculate how much the appraisal value deviates from the transaction price. So you can see as local price dispersion increases, the deviation of the appraisal value from the transaction price becomes bigger. Okay, and then with the appraisal channel, we should also be able to see the price dispersion effect on mortgage also hold in the securitized loan market segment. And so here we divide all mortgages into two groups. One is the portfolio loan, second is the securitized loans. And so first of all, you can see the effect of price dispersion also hold in the securitized loan market segment. But what's really interesting is the effect is smaller, right? So if we compare the slope of the two lines, the blue line is the securitized loan, the red line is portfolio loan. So what it tells us is that appraisal channels actually leads to a smaller difference across borrower creditworthiness, which is consistent with our prior, right? Because for collateral channel, lenders really want to price in the collateral risk if the default likelihood is higher. But for appraisal channel, there is really no incentive for lenders to care about whether the default risk is higher. And so what we're showing you here is actually through the appraisal process, GSEs and all of the securitizers are able to enforce lenders to price in the collateral risk, but they are not able to achieve the efficient level. Okay, and then we do a lot of robustness. Number one is we want to show that the results are really not driven by clustering between low-income people or less creditworthy borrowers and houses with higher price dispersion. And so here I'm showing you the default. Right, so here we define default as 60-day delinquency within 2 years since origination. And the figure plots the average default rate for low dispersion transactions and high dispersion transactions. And so the blue line is low dispersion, the red line is high dispersion. And so you can see actually default rates are not significantly different across the two samples. And then we can do this in a very rigorous regression setting. We regress default rate on zip code price dispersion, and we don't see any significant effect. And if there is any, actually the default rate is lower for houses with higher higher price dispersion. And we did 3 additional robustness tests. Okay. Number 1 is we include lender by zip code by year fixed effect in order to control for lender market power. And so this is really not about the supply side market frictions. And then we further look at a subsample of houses with sell price way below conforming loan limit. And so the lower LTV is now driven by bunching below conforming loan limit incentive. And lastly, you may worry about model specification or some measurement error. We also did repeated cell estimation in our baseline in our robustness test to ensure that our measurement is there is no measurement error. Okay, so and after we establish that actually house price dispersion can affect a mortgage, we then want to study the real effect on home ownership. So there are 2 goals of the model. I'm not going to go into detail of the model, but I want to briefly talk about the motivation and also what we can get out of the model. And so number 1, we want to know how much should the dispersion induced LTV changes affect home ownership rates. And so we're going to have a life cycle model that really want to map the documented dispersion induced LTV constraint on home ownership. And then we want to know how does this vary for different household incomes, and then we want to understand whether this contributes to home ownership gap. Okay, so briefly talk about the model, and that's the only slide I have for the model setup. So we use the life cycle model to quantify the real effect. We model lifetime consumption decision and also home purchase decision of households. And households can borrow to finance the home purchase decision subject to this collateral constraint. The collateral constraint is tied to the house quality this household decides to choose. And so we calibrate the model, all parameters are taken from the literature except for this collateral constraint parameter. And so as I mentioned earlier, we really want to tie collateral constraint to house quality because what we observe in the data is there is a U-shaped relationship between price dispersion and price level or house quality. And so what we do is we separately estimate this dispersion to price relationship for high and low dispersion counties. And then we multiply that relationship by estimated dispersion LTV coefficient to make it map to the model, which is the collateral constraint function in the model. And then in the calibration, we want to compare the difference between high and low dispersion counties. And so the high and low dispersion counties have this LTV, the price dispersion difference about 2.2, which is about 2 standard deviation of price dispersion. So that means if we move from low dispersion counties to high dispersion counties, we are moving about 2 standard deviation of price dispersion. And then in the counterfactual analysis, we find that we can increase the aggregate home ownership rate by 1.5%. In other words, home ownership rate is reduced by 1.5 percentage point because of price dispersion. And then this effect is almost doubled. It's about 2.6% among low-income households. And if we use 2016 home ownership gap as a benchmark, this is about 7% of the home ownership gap in 2016. And then we show some consistent evidence with empirical relationship. And so here we empirically estimate the relationship between dispersion and home ownership gap. Right, so what I'm plotting here is the blue line. This is the home ownership rate for low-income people or people below medium income in each county against the local house price dispersion. And the red line is the home ownership rate for high-income people in the same county. And so what we get is for every 1 standard deviation price dispersion increase, that maps to 1.29% drop in home ownership rate overall and about 1.5% for lowest income decile, which is somewhat consistent with what we find from our model. Okay, let me take 2 minutes to conclude and discuss, one minute to discuss and conclude. Okay, so what we show in this paper is value uncertainty of the collateral is a structural phenomenon that is contributable to the intrinsic features of the housing stock. And this is an overlooked variable that has quantitatively large effects on credit in the US housing market. Importantly, this collateral value channel is not really a form of discrimination. Lenders, even lenders in competitive credit market, should have higher cost to lend against those poor collateral, and therefore they should charge a higher interest rate, or they should provide a lower LTV, a smaller mortgage. And so that provides some justification for government interventions such as FHA programs that target low income and try to provide more credit to those group of people. And so low income households tend to live in high dispersion areas. That's something that I'm not showing you today, but that's something we find in the data. Those low-income households tend to live in areas with higher price dispersion, so they really have no choice to get a better collateral. That would affect how much they can finance the mortgage. And therefore, if we can get more mortgage, also in other words, is those people will get less credit even in fully efficient lending markets, and they are the group of people who are more collateral, they're more credit constrained. With that, thank you very much, and I look forward to Anthony's discussion.
Great. Thank you so much, Erica. That was great. Okay, so the discussant coming to us live from Chicago is Anthony DeFusco.
Can you hear me all right?
Thanks for having me. Sorry, I can't be there in person. It's not because I don't want to. I would take any chance to visit Philly that I can. I spent some time at the Philly Fed. I was in college there and grad school. So thanks. Okay, so Erica did a good job describing this paper, so I won't go into too much detail, but what's the research question? How does house price uncertainty affect credit supply? And I'm not sure that Erica and Anthony are aware of it, but this is actually a research question that has pretty deep Philly Fed roots. It's quite closely related to the literature on what's called rational redlining. If you go back, the first paper on this was actually by my former boss at the Philly Fed, Bill Lang, and Leonard Nakamura, who I think is still at the Philly Fed. Basically the same idea, saying that one of the reasons why you might see less lending going on in some geographies is because the markets there are quite thin, which makes it difficult to predict the value of the collateral there. And so you get stuck in this equilibrium where low volume leads to low credit supply. And there was a sort of a set of empirical papers trying to test that idea. I think the most recent one was by another Philly Fed affiliate, Todd Vermiglia, looking at this, really, again, thinking about volume and market thickness as the source of uncertainty, but the broader idea being that collateral that has uncertain value is hard to lend against and therefore can affect credit supply itself. So I think of this paper as sort of being like a kind of an all-inclusive way of thinking about that, where instead of thinking about, in particular, just market thickness or volume as the thing that's leading it to make it difficult to predict the value of the collateral, it's really what this paper does is try to include all sources of uncertainty. So the approach here is estimate pricing uncertainty at the individual house level, then go out and correlate that measure of uncertainty with different measures of credit supply. And then at the end, given what we see about how that uncertainty affects credit supply, we calibrate a life cycle model to figure out what the implications of that would be for home ownership, say, in the absence of something like the FHA. The findings Erica went over are straightforward. They find that higher pricing uncertainty leads to smaller loans for the same house, so smaller loan to price ratios, higher interest rates at any given loan to price ratio, and more rejections when you aggregate that uncertainty measure up to the county or to the census tract level. And then that results on smaller loans. That's the one they feed into the life cycle model and derive implications for homeownership from. They find that the degree to which this is reducing loan sizes would imply less homeownership in the model were there no FHA, for example. So I'm just going to have three comments. One on measurement, how the measurement's being done, and what the kind of conceptual thought experiment that the authors are running, and how it relates to what it is they're actually trying to measure. I'll have one comment on magnitudes, and then one comment on the model. So you can think of it as the 3 M's: measurement, magnitudes, and model. Okay, so measurement. So let me just go over exactly how price uncertainty is being measured here. So Erica did this well, so I'll do it again, just kind of at an even simpler level, right? So the idea here is basically going to be a 3-step process. So the first thing you're going to do is you're going to take a sample of housing transactions and regress the prices of those transactions on a set of characteristics. So just run a basic hedonic regression. I'll keep it simple here and just use age as the house characteristic. We'll predict the average price from that regression, and then we'll just collect the residuals from that. We're then going to ask, okay, what is the average residual at each level of that housing characteristic? And we'll plot that against the housing characteristic, okay? And step 3 is to just call that pricing uncertainty, okay? So the measure of price uncertainty here is really just how heteroscedastic is this hedonic model. And so you can think of a house's pricing uncertainty as being a function of its underlying characteristic here. In the case of the age of the house, it is more difficult to price or to predict the price of older houses. Okay, and so that's the idea. And then the question is going to be, do older houses have lower loan to price ratios as a result of this? Okay, so that's what's being done. I think the question is what exactly is being measured here, and how does it relate to what we might want to be measuring? So I think the best way to think about what the hypothetical being measured here is what if you wanted to try to predict the price of some random house today, knowing only its characteristics, right? And what this is going to tell you is how far off on average should you expect your prediction to be as a function of those characteristics. I think one key thing to note, though, is that, you know, in most instances, lenders don't need to predict the price today, right? The price today is known. It's what the buyer and the seller have already agreed to do or agreed on. And so there's not really a sense in which the price today is unknown. The lender doesn't have to run this hedonic to figure out what the price is. What the lender does care about is you know, what the price tomorrow is going to be, right? The hypothetical we really want is for a given house with known price P today, what's its future price going to be? And in particular, what's its future price going to be in the state of foreclosure? Because that's when the collateral becomes valuable to the lender. And so these can be very different things, right? What's being measured with the hedonic can be very different from what the lender theoretically actually cares about. I think, you know, a couple of sources of differences here. One would be, you know, if house level errors are persistent, so if these dots are always above the line or always below the line for a given house, then, you know, by the time that house ends up in foreclosure, this cross-sectional variance is of the conditional cross-sectional differences in the conditional variance are sort of irrelevant, right? And then beyond that, it's, you know, the conditional variances you're picking up here as a function of age for market sales, which is what's going into the estimation of this, might end up being very different from what those variances would be in the state of foreclosure. I think the paper is very aware of this. These results haven't yet made it into the paper, but Erica alluded to them, so I do think they're working on it. There's an obvious fix to this, which is just to do all of this in repeat sales. So instead of looking at the hedonic here, try to predict what the price of the future price of a given house is going to be as a function, again, of its characteristics, and then project the prediction errors there onto those characteristics. I think that's going to map more tightly to what lenders are theoretically thinking about here. As a bonus, you could even restrict to repeat sales pairs that end in foreclosure, because it's really that foreclosure outcome that's the relevant one for thinking about the value of the collateral to lenders. Okay, great. So that's the comment on measurement. I think the paper is headed in that direction. I think it's an easy fix, and my guess is that it's not going to change too much. The second comment I have is on magnitudes and just thinking through the size of the effects here. So the bottom, kind of the headline result from the paper is that loan to price ratios are about 20 to 46 basis points lower for houses that have a 1 standard deviation higher price dispersion as measured by this average error from the hedonic. So what is I think it's useful to think through, okay, what is a 1 standard deviation higher, or what is a 1 standard deviation increase in price dispersion? So if you look at the average house in the sample that they're working with, the average house in the sample sells for about $270,000. And so I constructed this figure so that kind of running along the x-axis here across age sweeps out on the y-axis on the right side of the slide here. That sweeps out about a 1 standard deviation increase in the price dispersion measure based off of kind of the summary stats from the paper. Right, so a 1 standard deviation increase in price dispersion equates to about a $60,000 higher average pricing error. Okay, so the result is that when you can predict the house with plus or minus $60,000 more uncertainty, that's going to lower the loan to price ratio by about 20 to 46 basis points. I think a useful way to think about this is, okay, what happens if you go from the left side of the figure on the left of the slide here? So going from perfect prediction to being able to predict the house with price of the house with plus or minus $60,000 error. What's that going to do to the loan size? Well, the average loan the average transaction in the sample has an LTV of about 85%. So it's going to reduce the LTV from about 85% to about 84.5%. And so the loan on the typical house is going to fall from about a $229,500 loan to a loan for about $228,400. So basically, the result, the quantitative result here is that moving from being able to perfectly predict the house price to being able to predict it with plus or minus $60,000 error for the average house is going to reduce the loan amounts that the buyer can get on that house by about $1,000. So I think it would be useful to sort of benchmark this number. I don't know if this is large or small. I think of it as small, but it's not. It could be. It's sort of, you want to think of it as large or small relative to what, right? Because if the default rate was literally 0, then you should have no effect here. So for very small default rates, maybe this is the right order of magnitude, but I think some sense of the kind of the economic significance of this effect would be nice to have more discussion of that to sort of complement the standard deviation results that are being presented. Okay, so it's kind of related to this magnitudes comment. The main way that the paper sort of gauges the economic significance of the key results is through the lens of this life cycle model, right? The idea is we're going to interpret the economic significance of results through the model. In particular, we're going to think about this effect on loan size and ask, what does this effect on loan size or on loan to price ratios do to equilibrium homeownership rates in a sort of calibrated life cycle model?
Okay? We got about a minute left, Anthony.
Okay, great. I'll try to move quick. So the result for the model is that moving from high to low price dispersion counties increases homeownership by about 1.5 percentage points. How does the model get to this conclusion? Well, it's important to think through what homeownership in the model is. The paper models homeownership as a discrete choice across a range of housing characteristics. So how you characterize those housing levels, those levels of housing that you can consume, is important. And in particular, the point I want to make here is that the grid that the paper is using for this is quite coarse, which I think is going to lead to small changes in loan to value ratios, leading to large changes in homeownership rates. Because in order to transition into homeownership rates, you have to buy a house that's basically twice as big as the one that you can rent. And so any small change in LTVs is going to apply potentially large effects on homeownership. I think there's a fix here, which is just to allow households to both rent and own the same housing quality and ask, what does that same change in the LTV do? But let me stop there because I'm probably out of time. I think it's a really interesting paper. I think it's a new look at an important question. And I just had those 3 comments on measurement, magnitudes, and the calibration of the model. Great.
Great. Thank you, Anthony. Erica, why don't you respond very quickly so we have some time for some questions?
Thanks a lot for all 3 comments. I basically just want to demonstrate the first question, and the other 2 comments are well taken. So in the paper, we actually did a repeated cell, but we didn't include that in the paper we sent to Anthony. And so that was definitely one thing we thought about that's really important. But I want to mention 2 things. One is if we do repeated cells, that's going to restrict our sample to a really small set of houses. We really want to provide a comprehensive analysis. And secondly is we show that this idiosyncratic price dispersion is relatively persistent over time. And so that definitely addresses our original concern that whether cross-sectional price dispersion is also important in terms of foreclosure. So if this price dispersion is persistent over time, that's something that lenders should also care about when in the future when there is a foreclosure. But we can definitely also look into the houses that also ended into foreclosure and see if the results actually hold in those small subsamples. I think with that, all the other 2 comments are well taken, and we will think about that as well. Thank you so much.
Great. So we've got a couple of questions. We'll go to you first.
Hey, really interesting paper. And this is kind of minor, especially in the context of what Anthony said about trying to predict foreclosures, not current prices. But Zestimate has a mean squared error on their estimates, and that's a pretty nice measure of what could be predicted with a pretty good model of predicted prices. It might be nice to contrast that. I think they have it county by county at least, and contrast that against your measure and just validate what you're doing makes sense and that this is sort of correlated in the same direction.
Yeah.
So then we'll let Leonard, given that he got a shout out in the discussion, we'll let Leonard Nakamura ask the next question.
Yeah, thanks. Really nice paper. One thing in my work with Bill, what we were trying to think about is really about land value and how you figure out what the value of a location is. And the other side that gets in there is, what's the idiosyncratic nature of a particular house within a location, right? So if you have the wrong number of bedrooms or something like that, that's about idiosyncratic, and that's complicated, right? Because the borrower is choosing a weird house for that neighborhood, right? So I think it'd be interesting if you could separate, the land-specific things from the house-specific things.
I think one thing is in the Handonic model, we also try to incorporate the geo-coordinates or the specific property location. I think that partially captures the land value. And on top of that, we include a lot of housing features that tries to show how non-standardized the property is. I think that's definitely a good point, and we try our best to address that.
So we'll give it to Steve and then Jiang.
This relates to one solution to the issue of the repeat sales being a smaller, use the repeat sales sample to quantify how much of your dispersion is associated with the time invariant unobserved attributes of the house. Then you can use your full sample to measure dispersion and net out that portion.
Oh, that's a very good.
The other thing I want to comment more related to Lenny is I also think it'd be nice to be thinking a little more about what the different sources of dispersion are, right? And this goes back to the idea that some dispersion is sort of like happening at the location level, some dispersion is happening because the unit is unusual. But more importantly, I think, and this goes to a lot to these low-income areas, some dispersion happens because of the person there. And that happens because people who are in financial distress will have a different reservation price when they're selling. People who have to move to get a new job somewhere else will have a different reservation price when they're selling or versus buying. And so I think this idea that the individual themselves is influencing how much uncertainty is really important. Maybe HMDA matched could give you some insights in that, I'm not sure.
And so one thing we do see in the data is low-income people tend to live in areas with higher price dispersion. I believe that's definitely driven by the frictions you mentioned, either liquidity issue of buyer and sellers, and also they probably don't have a good maintenance of the property.
And Jiang, just be fast, I guess.
Oh yeah, so I just want to push a little bit regarding kind of like along the line of the comments by, the first comment by Anthony. I will be very precise regarding, so somewhere you claim that, from the lender side, all different channels of the dispersion does not matter. But let me just give you one example. I think that matters. Just think about the third friction you put in there. I want to differentiate between the uncertainty of the house buyer, and the uncertainty facing the lender, right? So even if the lender knows every single thing regarding every single house, but there is still buy-side uncertainty. If you think about a standard housing search model, there is uncertainty facing the buyer, but once the buyer got the house, take the house, try to get a loan from the lender could know everything regarding the appraisal value. So there is no uncertainty to the lender side. So unless you build a more complicated model, try to circle back, say that the buy-side uncertainty also lead to uncertainty facing the seller, I don't see how the channel would work, right?
So you are talking about the asymmetric.
So I think that like the way they are affecting the things is like uncertainty is because uncertainty the lender is also facing. So the uncertainty the lender cannot decide. So therefore they feel there is a risk and they charge higher or they reduce the lending, right? But search friction, if you're talking about the housing search friction, is uncertainty from the house buyer, right? So there are 1,000 houses I can search. There is uncertainty in terms of like the final house I can get. There are same like prices, like price dispersion. But once I got my house, take my house to the lender knows like the value. There's no value uncertainty to the lender. And then there is no kind of this collateral risk channel.
I think
maybe we'll stop it there. There's one question. I'll let you guys talk about that in the break a little more. There's one question from Adam Gurin. I'll just let him ask his question quickly, and then we'll finish on that, and then you guys can talk more in the break.
I can just email
Adam,
her.
do you want
Fine.
Sorry?
I can just email her. It's fine.
Okay. All right. You can email. Okay.
Right.
Okay. Well, on that note, thank you, Erica. That was great. Thanks, Anthony. So we have a 15-minute break now. So thanks, everybody.